Hey, all right, we're all off. All right, Scotty from Zenium Live, and today I'm joined once again with PJ Patterson for our fortnightly market analysis. How you going, PJ?
I'm good, Scott. How's it going today up in beautiful Queensland?
Well, good mate. It was my turn for technical gremlins today. I kicked open my old podcasting mics and equipment, and it was all working in a test, and then we went to go live and decided not to work. So that was awesome.
I know it is. Well, you got the real deep voice going at the moment, so you've got that bass super low, which is good. Makes you sound,
No, no, mate, no. It's
very
actually
white
down
like.
at minimal. It's just that this is the real me, and the other mic was some sort of fake sort of
The Mickey Mouse
audio
mic.
sound. Yeah, that's right, mate. So this is actually how I am, really. Yeah. So all right, look, let's kick off. After our last chat, we had some good feedback on people wanting to know, what was going on in the markets, that sort of thing. And I'd pulled you on because we'd had a brief discussion. I said, "Oh, come on the show," and look, we had a few people like that. So I said, "Okay, well, let's make that a bit of a thing." I know we talk about property, but the markets are very intertwined, right? Like we got property and financial markets and all lots of bits and pieces. And I think it's good to have that information from a bunch of trusted sources, and that's what we try and do here at Zenium. So
Good.
my well, I'm going to throw it to you in a sec, but give us a rundown since you're here last time, like what's happened in the past 2 weeks in the markets, and then I've probably got some questions that a few people sent in. So over to you, mate.
Perfect. All right. Well, the last few weeks of the markets have been very interesting, no doubt. We have seen what I would describe as a bear market bounce that's sort of retraced about probably about 50 to 60% of the initial sell-off that we saw about 4 weeks ago when this whole COVID thing blew up. And I think what the market's doing right now, and this is the global market, I'm not just referring to the Australian market or the US market, the European markets. I think global markets are certainly searching for what you would describe as a bottom. And they're also searching for hope of what will be the catalyst to break us out of this malaise, which is COVID-19, and how it's impacted basically every economy on the planet. The caution that I will give to you and your audience is that we are probably not even halfway through this crisis. We haven't really begun to see the economic data being reported from the early part of the COVID crisis. And the data that we are seeing reported, for example, earnings season has begun again in the US. And the earnings that are being reported by companies are actually the pre-virus earnings. So if you're going to look at earnings reports for companies this quarter or this month even, you have to realize that and they are bad, they're looking very bad, you have to realize that we have the worst is yet to come, I guess is my point. So if anyone out there who is a property investor who's worried about their super or maybe dabbles in the stock market or does some investing, my caution would be to probably not buy this rally and not feel like you're missing out on the bottom, because I think well and truly we have months and months to go before we are out of this crisis and the economy fires up again.
So there was something interesting. Like I don't follow markets. Like even a bunch of my clients follow markets a lot closer than me, and I'm kind of just a headline grabber. But I woke up one day this week, and what is Wednesday or something, and my news feed was filled with oil being sold below zero. Um, Mate, do you want to explain to us what happened there? How is that possible that oil can be sold below zero? And is this the norm? Is this the new
Yeah.
normal?
Okay, so the oil going below zero was in reference to the May futures contract, and it can happen. And the circumstances by which that did happen are as follows. So if you think about what's happening, the overall dynamic in the oil market right now is demand has fallen off a cliff. We've had people sequestered at home, travel being restricted, airlines cutting capacity by a significant amount. Shipping is probably down. People are just not consuming gasoline, petrol, and oil-related products. So what's happened is the producers of oil, so the Saudis and the Mexicans and the North Sea, the Swedes and all those guys, the Norwegians, they're not going to stop pumping oil. They have to keep pumping oil. And so what happens is storage facilities and tankers and things like that, they fill up. So effectively what's happened is a situation where traders who were trading the front month or May futures contract probably panicked and went, oh my God, we can't take delivery of oil because there's nowhere to put it. So we don't have any storage. And so you just basically saw them selling it at any price. And believe it or not, they were paying people to buy the contract out, which is a very, very unusual situation. I don't think it's ever happened before in the history of oil futures trading, but a very unique situation. But I think it really just relates to how the situation has unfolded with the storage of oil.
So this might sound like a Quamby question, but is it ever possible that these guys holding these contracts, this is for an X number of barrels of oil that they are selling to someone else, hopefully, right? This is the idea of a futures contract. So they bought 1 million barrels and they hope that in May they're going to sell 1 million barrels to someone else and make a small margin, right? Is this how these contracts work?
Well, generally speaking, the futures markets are there as a price discovery mechanism. And you have really 2 or 3 different types of players in the futures market. You've got the actual producers of the commodity who use a futures contract to hedge future prices, right? So they might sell, a forward contract 3-6 months out to someone that's consuming the product, like an airline, as an example. So effectively, they lock in the price that it costs them to use that particular commodity. Sorry, what was the second part of the question?
Well, I guess my point is, they're attached to real, so it's not like paper trading, It's actually real stuff.
So it is. So sorry, that was the other thing I was going to say about that, is that, so that's the first type of person that's in there, is the actual commercial, they call them a commercial, right? The commercial entity that is buying or selling it to actually use it. The second type is a speculator. So someone like you and me, who we might have a futures trading account, and we might be trying to play the price movement in the futures contract and actually make a profit. So we have no intention of ever taking delivery, and we're just trying to, maybe a profit from the price movement. Those are more of the speculator type. And then you have what's called a non-commercial as well, which is maybe a bigger player. It might be an industrial company or something like that as well, but they're not a producer. I've just lost my camera. No, it's okay. Heard it click. It might be someone that's that third category, that's like a large entity, a company or corporate, or someone that also is going to consume it and may want to take delivery. So those are kind of the 3 players in the market. So it isn't all just speculation that has caused this. It's literally an end user has probably said, I can't take delivery of this stuff because I have nowhere to store it. Therefore, I have to get out of the contract at any price.
Yeah. And that's, I guess, where I was trying to get to. So at some point, these deliveries are going to happen. Someone needs to actually get the physical oil and use it, take delivery of it, store it, whatever. And hence, this is where the pricing was driven to below zero.
Yes, correct. So the contracts that are out on the futures market aren't necessarily representative of the volume of oil that's going to be delivered. So there can be in futures markets and a certain part of that market that is purely speculation, that the contract will not ever be delivered on. And again, they're just trying to just play the price movements of the underlying commodity. But certainly, there will be an aspect of the commodity market, or in this case, the oil market, that will absolutely be delivered. And you've seen a mad scramble by a lot of the commercials and the people that are going to take delivery of this stuff to secure storage. So again, that's where we've had this problem where it's forcing out anyone like a speculator who might otherwise have been able to secure storage, rent an oil tanker, or find facilities where they could store this stuff when they take delivery. And they can't do that right now. So they have to sell at any price. And in this case, pay someone to take the contract on.
Well, that's it. So is it worth, us Aussies, I got like 5 jerry cans. Can I get some oil and at really cheap and then sell it later?
You probably wouldn't be able to do that. I think there's, the standard futures contract has a certain, framework of delivery. I think The standard oil contract might be for 1,000 barrels or 100,000 barrels. I'm not really sure anymore.
Wow.
I haven't looked at that. But I think if you had enough storage on your property, Scott, to store 1,000 barrels of oil, why not? Go
Yeah.
for it. But
All right. Well, I'll have to look into that. I'll start digging a hole.
I
All
think
right. So
so.
then my next question is, I mean, oil is a commodity, which is something physical that's tradable, right? That's pretty much a broad definition of a commodity.
Yes.
Um, is this made the headlines because it was so unusual? Is that just unusual for oil, or does this sort of stuff happen for sugar or wheat or whatever else is out there?
I don't know that you would see a futures contract in other futures markets go to a negative value. But now that has happened in oil, certainly it could happen in other. I think it could happen in other commodities where storage could be a problem. So could it be a problem with something like wheat or soybeans or any of those things that have to be stored? Absolutely. Chances are, though, because certainly something like wheat or soybeans would probably get bought up, consumed fairly quickly, because demand for bread and that sort of thing, that's more of obviously a consumer staple, would probably alleviate or prevent something like a negative futures contract from happening. But who knows? It very well could. Something like a base metal or any of these other things that you could just stockpile, like you just said, dig a hole on your property, or clear a space and just dump iron ore or whatever. You could probably keep that on site without too much trauma and not see a futures contract go negative. So I think it's probably unique to the things that have a limited storage capacity on the planet.
Yeah. And I guess the issue with oil is that unlike wheat or soybeans, which are, depending on the country, growing in season, they're not growing technically all year round, right? They kind of have their planting and growing and harvesting, that sort of thing. Oil
Yes.
comes out daily. And unless they roll that back, that's a continual supply that is always happening.
It is. And oil producers don't want to shut down production because it's very difficult to stop producing oil and to restart it. So it can damage the facilities. It requires a lot of maintenance and all this sort of stuff. So they actually need to keep pumping the oil, which again creates a situation where if they're pumping it, then it needs to be stored. So we may very well see in the coming months and here that oil producers are beginning to shunt and shutter down production and stop and cap wells and do all that sort of stuff. It's very, very possible, and they may have to do it anyway, because if the price of oil, and the last time I checked today, I believe the price was trading at about $8 US a barrel, which is unbelievable,
Yeah.
unbelievably low. They may very well have to do it because it becomes very uneconomic for them to pump oil out of the ground at that price.
Okay. All right. So moving on from oil and commodities, you touched on the profit. Would you say the profit, the company profit reports coming out, but that was based on the quarter before COVID, right?
Yes. So right now we're having companies in the U.S. The S&P 500 have begun to report earnings. I think about 55 of the S&P 500 have reported, and the earnings across the board, aggregated from the 55 companies that have reported thus far, is a minus 30%. So this is pre-COVID really impacting their earnings, and they're already down. Earnings growth is down a large amount. Now that'll probably come back a little bit because obviously as you get more and more companies reporting, not all of them will have had horrendous quarters, but a number of companies in the financial sector, energy, and consumer discretionary have reported, and not good at all. So what it alludes to is the fact that the economy was already slowing. And this is something that commentators in the media aren't really willing to admit yet. I think they keep saying, well, this COVID thing has messed up the world economy. But in actual fact, we were already slowing down. And this is something
It was just the
that,
pin, mate. It was just the pin.
well, it certainly is going to make things worse. I think we were already slowing down. Whether we would have had this drastic, situation unfold like it has is unlikely. But COVID is certainly is going to cause a tremendous amount of economic damage. And this is the message I keep saying to my clients, and I want to keep bringing to yours as well, is that we're not out of the woods. We are not going to see a V-shaped recovery, which is typically what we have seen in crises like these over the last, say, 10 years or so since the GFC. is the Fed and central banks around the world have really moved quickly to provide liquidity and print money. They've done that this time as well. But this time is different because the consumer, which is a big part of the global economy, spending, is sequestered. They're at home. They can't spend. They can only probably do so much online shopping, which benefits companies like Amazon. That's great. But the retailers, the local shops, all of the small businesses around the world, they're going to be really hurting right now.
Yeah, well, I don't know how many staff they put off when this happened, but Myer would have put a fair few off. But I read yesterday they brought back 2,000 because they've been inundated on the online shopping side of things. So, I mean, that's that sort of trend that you're talking about there.
Yeah.
So with that in mind, I mean, so it's just the quarterly report. So that's the March quarter. So we're looking at towards the end of July for the next quarter to come out. Is that right?
Yeah, so most reporting is done sort of on a monthly basis, but
Right, okay.
yes, the quarterlies are the biggies, and the June quarter is going to be horrendous. And I suppose to that end, we also have not yet seen in the Australian economic data, we haven't seen anything yet on GDP for Australia reported yet. I guess we'll be getting some GDP figures in May. We haven't really seen the unemployment figure in Australia capture all of these layoffs and redundancies and so forth that occurred in the probably second to third week of the COVID crisis. So we have yet, again, my point is we have yet to see the full brunt or bear the full brunt of the bad economic data that is headed our way. And that's why I'm saying to everyone, just cool your jets on wanting to run back into and say buy the banks or buy the financials or buy really anything at this stage until we get some more visibility on how much economic damage has been done.
Yeah, okay. All right. And so my question is, as I said, I'm a very light follower, and I've probably followed a little bit more since I knew that you were coming back on to have these discussions. But I did see something about, I wouldn't call it a rally, but how there's some of the US markets are actually either I'm not saying they've increased, I don't know the correct wording, but they've gone up or had a bit of a run or whatever when all this negative news is going on, which seems to be completely opposite to what normally happens. Is that just because of pumping liquidity or what?
It would be interesting to know what markets specifically you're talking about, but I guess it alludes to something that I tell all my clients, and I'll tell yours as well, and that is there's always a bull market somewhere. So there are certain markets that are segments of the market that are rallying. So what you have to understand is that the universe of investment potential is much larger than just stocks. And even within the stock market, there's a lot of sub-asset classes and sectors that actually perform well in a crisis. So a great example of this is treasuries and government and sovereign debt. In a crisis like this, where this central banks and the Federal Reserve in particular are cutting interest rates, that drives bond prices higher. So we've had an epic bull market in bonds over the last 16 to 17 months. That's where you would have wanted to have your money, in bonds, because you would have been killing it. We've seen some portions of the equity market, consumer staples, held up pretty well up until volatility in the market hit an extreme level. And then even those equities succumbed to a lot of the panic selling. So I guess the point I'm making here is if you are an investor in the equity markets or in the markets outside of, say, property, there's always a place for you to put your money to A, protect your capital, and B, profit from whatever's going on. And that just basically is the strategy of full cycle investing, which is what I really adhere to in my firm.
Yeah, okay. Now that's good. So at this time, people, as I said last time you're on, they're going to be concerned about their capital. They're concerned about cash flow. I mean, is cash still the position to be in right now, or are we looking at? You're sort of alluding to it's a little bit too early to jump in and grab some good buys because we found the bottom yet. So that's cool. Let's assume that's the case. But is there anything that we can do right now to generate cash flow from our capital, or is it all just like put the barriers up and lock it away?
Excellent question. And my response to that would be there are some segments of the market where you could be safe to put some investment capital to work and to generate some cash flow, although the yield won't be massive. That would continue to be your government and sovereign debt. Cash right now is absolutely king. We're at that point in this market cycle where there's so much uncertainty and unknown that I would certainly have a high portion of my investable capital sitting in cash. The other place you might look to would be gold. Gold has come into it was hit a very high volatility figure a couple of weeks ago, which made it sort of uninvestable. But that's really come back, and cash is now flowing back to gold as an asset class, which is different, by the way, than the miners. They're an equity, so you'd have to be very careful about speculating in the gold miners. But certainly, gold via an ETF or even physical gold would be okay. But I prefer the ETFs because you have liquidity. You can get in and out of those quickly. But that'd probably be about the only place right at the moment that I would be putting the capital that you have on hand to get any sort of return. And cash is actually going up in value because we are in a deflation right now. So cash is actually getting more valuable.
All right. Well, so for us simple property people, do you want to explain how we can have a whole bunch of liquidity pumped in from governments, and not saying there's more cash around, but more cash sort of pumped into the system, and yet we're in a deflationary market and therefore cash is going up in value? Just break that down for us simpletons, mate.
Sure.
Like me.
So, so what happens with liquidity is that the Federal Reserve or other central banks around the world will provide liquidity by buying assets from banks. So typically when you hear this whole discussion about liquidity being provided, it's because there's some problem typically in the credit markets. So a bank might, I won't name any names, but let's just say XYZ Bank might have put a lot of money out into, say, the corporate credit market, and they invested or put a lot of their loans out to maybe marginal debts. Let's say you have a bank that made a lot of loans to oil producers, right? That would be a really bad place to have debt right now. And so they're panicking because maybe they are at risk of default. They might not be getting their coupons, whatever. So the Federal Reserve, in this case, in the U.S., will have opened up what they call their discount window, or their asset purchase window, and they will offer to buy these assets or take these assets on the Fed's balance sheet to provide that bank with liquidity. Now, that just means that the bank now has more cash to shore up their balance sheets to meet Basel requirements for liquidity and solvency and all this sort of thing. It doesn't necessarily mean that that cash makes its way directly into the economy. And this is, I think, where people maybe misunderstand that a little bit, is they think just because the Fed has come in with these rescue packages, or they're saying we're printing money and we're going to give that to the banks who should give it out, it doesn't necessarily mean, and in most cases it doesn't get all the way to your pocket and my pocket. It stops at the mechanism of the bank because they hold on to that capital to shore themselves up, to make sure they can meet their financial obligations and that we don't have a financial panic. So what then happens is, because people aren't spending money, because we're seeing, as an example, the price of oil is a great example, has come down massively. It's really deflated. That is a sign of deflation. So if you just go back 3 or 4 months, a barrel of oil was $50 US a barrel, and it was fluctuating between 50 and 60. And today we're at $8 a barrel, right? That is a huge, huge increase in purchasing power of $1. Your purchasing power of oil just went up, I don't know, probably 60 or 70%. Now, that doesn't automatically translate into, a huge discount at the pump. But I think pre-COVID, I was buying fuel for, let's say, $1.25 a liter here in Sydney. And now it's hovering anywhere around 92 to 95 cents a liter. So that's a pretty big drop. But that's basically how deflation works, is stuff just gets cheaper, but really it's not getting cheaper. It's that your dollar, or whatever currency you have in your pocket, is able to buy more of things.
Yeah. Okay.
Did that make any sense?
Yeah, it did. I was just thinking about fuel price. I think, when we get round to, 70 odd cents, can't go any lower because it's probably all tax. But
that's probably true, actually. Yeah, mostly.
I don't have the figures. You can't quote me on that, but
Yeah.
would feel like that. We do live in Australia, so who knows?
Yeah. Who
So,
doesn't?
okay,
I
right.
can
So
tell
that's
you
how
though,
inflationary works.
yeah, and just to lock off that whole conversation about inflation, deflation, the metric that you would need to look at, and you'll hear this from time to time reported on in the media, but the metric that you need to be listening for is this. What is the velocity of money?
Mm,
So, velocity of money is how often a dollar changes hands in an economy. And right now, the velocity of money would be negligible, right? Because people just aren't spending
yeah.
because they're at home, right? And so once the economy gets back to whatever normal is going to look like when all this is said and done, what we would hope to see is the velocity of money will pick up. We'll see a recovery in prices of things like oil and other things out there, other base metals and other commodities. And then what the central banks are ultimately trying to do is to drive more inflation. So they actually want to see prices rising. And this is one of the reasons why they pump all this liquidity into the market is they want to try to engineer inflation, which actually is a
Mm.
bad thing for you and me. If you're a consumer, you actually want the price of stuff to go down, not
Yeah.
up, right?
Yeah.
Which is counterintuitive to the way they frame this whole thing in the market. So, but the velocity of money is the thing you need to listen for. When that starts to really go crazy, that's when inflation is going to start to fire up, and hopefully we won't swing the other way and go into some sort of hyperinflation.
All right. Well, I mean, maybe we can get into that on another day, but
Yeah.
there is a few people talking about hyperinflation sitting around the place. So,
Mm.
in the next, are we expecting any major reports or information releases in the coming weeks and months? Like, what's next on the markets cycle?
I think the next big reporting that we're going to see will be the GDP numbers. Once we start to see GDP numbers reported from the US, European countries, the UK, France, Germany, Italy, Spain, those biggies, Japan, Australia, obviously, we're going to get a real sense of how much damage has been done economically. So I think those will be the next big economic data points to look at is what's happened to GDP, because
Mm.
ultimately that's how recessions are defined. And and I'll just say it because I think it's true. I think we're already in recession, and I think we're going to definitely see 2 quarters of negative GDP in Australia and probably around the world. And beyond that, who knows, right? We just don't know because we don't know how long the COVID thing is going to sort of last. But
Well, that's
certainly
the
the
thing. Yeah, we
economic
need
damage.
that end date, don't we? We need that time when they say, okay, we can start to go back to, you know, just doing things as normal, even if you've got social distancing or wearing a hanky
Yeah.
over your face or whatever.
Yeah.
But the fact is that you can't, while it's this unknown, it's just sitting there, everyone's going, well, twiddling their thumbs.
Mm.
So, all right. And so that's the GDP stuff. Okay. Now, one question I did have that we want to put things into perspective because, you know, we talk a lot on property and the property market is, you know, a very big part of Australia
Mhm.
and its overall market and that sort of thing. We'll break that down another time in terms of, you know, how it does and doesn't impact GDP and all that sort of stuff because that's, you know, sometimes people think it does. But the question I've got is that in relation to the world stage, and I'm putting you on the spot here because I didn't tell you I was going to ask this, but
Right.
you know, where does Australia sit on the world stage in terms of its overall size? Just so that people, because we're very, you know, we're on our island here. Everything about Australia is it's all it is what it is, right? I mean, it's our complete life, I guess, when we're here. But I want to put it in perspective of where we sit in the world stage in terms of the size of the impact we have, because we're definitely not considered a large economic force, I'd imagine.
Definitely not. Our economy is a few trillion, which is not massive by any stretch. We are about 2% of global stock market capitalization. So in terms of overall, equities and so forth, we're very small. What happens in Australia is going to be, it's not going to make much difference at all in the world. We're not a big manufacturing nation. We're more of a services driven economy. So a lot of the wealth this nation produces is in raw materials like commodities and so forth, and then our services industries. So if something goes really, really pear-shaped in Australia, it won't matter a lot to the rest of the world. So from that point of view, if we enter a really severe recession here, or even a depression, it'll probably be more as a result of whatever's gone on in the rest of the world. So, and when we come out of it, will probably be determined by how quickly the rest of the world recovers. I mean, clearly we are tethered heavily to China, to Europe, and to the US. Those are the three big economic zones in the world. And if they're all hurting and in bad shape, then you can bet Australia is going to be in bad shape too.
Yeah. Yep. All right. Okay. So to sign off, in terms of actions for clients to move forward now, it's just still sitting on their hands in terms of coming to the financial markets, and it's a wait and see?
I think so. I would actually, though, take this opportunity because we have had a retracement in the initial sell-off. If you're thinking that you're out of the woods and it's just going to keep on going up from here, my view is absolutely not. This is the time to take money off the table, to get out of the market while you still can, because there's much more pain to come. Economic gravity is going to continue to pull this market down. And again, we will not have a V-shaped recovery. And we're probably in inning 2 or 3 of this entire economic calamity. So I would just have some patience and make sure that you've got ammunition. So that comes in the form of capital, and sit tight for the moment. And if you can, find some opportunities like buying government bonds and maybe some gold, and maybe make a little bit of return while you're waiting to deploy that cash into opportunities, which will probably come later this year, or maybe not even till early 2021.
And so in terms of recovery, instead of a V, you're talking about a U or an L?
Yeah, it's not even going to be a U. I think it's going to be an L. I think we're going to tick along for a number of months to at a very low level of economic activity, probably even negative activity, and then something will trigger a resurgence. We will have gone through the bankruptcy cycle, gone through the cleansing period that really should have been allowed to happen in 2008. But didn't. And so we need to actually let that happen. And then that'll sow the seeds for another great run of economic growth period. And I think the economy is going to, and this will be a good topic for another time, but I think there's going to be some big shifts in the composition of economies. That could be a topic for next week or some other time, just to think about how this crisis is going to change how people work, how they live, what they do.
Yep, no, that's a good point. All right, well, look, we'll leave it there. We've had a big smiley face from one viewer there, Shane Eggy. Thanks for stopping by and giving us a smiley face, Shane. Appreciate it.
I just realized my background has died.
Yeah, well, it just got tired, mate. It actually from this angle looks like a V, so it's kind of going against what you're saying. It's going on a V shape there. But
that could be a sign.
Could be. All right, look, we'll see you again in a couple of weeks. Thanks for stopping by. And if you've got any questions for PJ, hit us up on the email below, hello@zenium.property, and anything you want to say or on this post as it gets shared around, and we get a thumbs up there from Shane. Thank you. PJ, thanks again for joining us, and that's it. If you want to know more about anything PJ's talked about, as I said, hit us up on the link that's been flashing below. And for those people listening on the podcast, just go to www.zenium, that's XENIUM.property, to see our website, and hello@zenium.property for the email address. All right, PJ, thanks for joining us, and we'll see you again next time.
See you in 2 weeks.
All right, ciao.